Welcome back to the channel, everyone. Today I want to share with you a clip, or the entire video actually, of an analysis that I did on the Patreon page the other week, just analysing a company called THG, based in the UK. They're a tech company that's growing very quickly. They IPO'd around a year and a half ago and had a fairly sizable valuation, but as you can see, the stock's down 69%, almost 70% of its value has dropped year to date. So it's not having a good time whatsoever. I did an analysis on the company around this 290 or 289 pence range. It's now dropped a further 16% off the back of some, fairly weak news, just to do with the executive director appointment, who's from Softbank, and the market don't seem to take any news well from this company, even though they loved it a year ago. I personally think it has the opportunity to provide some good outperformance versus the market off of some fairly conservative assumptions, especially versus what they've been able to do in the past year or year and a half. So just thought I would share this video with you guys as I'm preparing another video to go up on the channel tomorrow or Thursday at the latest. So enjoy, let me know what you think in the comments below of THG, and hopefully it's an interesting insight into a potential opportunity for some of you. Whenever a drop like this happens, i.e. almost losing half its value in less than a month, I always like to put the situation under a microscope and see if it's possible that the market has overreacted and presented us with a good opportunity to buy into what could be a good company. So we need to look at all of that. We'll look at why it's dropped so much. But the first sense check I do when this happens is try and check the valuation, because after all, this will indicate to us whether the sell-off was purely price-based, and if it was selling at a ridiculous multiple and now it's sort of corrected back down, I'm not going to be that interested. But if it was selling at a fairly reasonable price before that and is now selling at an even more attractive price, then I definitely want to dig into the situation. So we can see here the current multiple. Actually, it might be easier if I get this up on a chart. We'll look at EV to revenues for now. Look at the forward multiple for EV to revenue. So when it first listed, it was selling at around 4.5 times or 4.7 times next year's EV to revenues, which is fairly expensive. But again, this is a company that was growing at over 40%, in excess of 40-50%. So some would say it was justified at the time. And we'll look at the financials and how quickly they're growing in a moment. But we've gone all the way down to 1.36 times next year's EV to sales, which even for a company that isn't growing that much, if it had the potential to get a margin in excess of 10-15%, that would be a relatively good multiple to buy any company at, regardless of how quickly it is growing. So to recap there, we've gone down from what was a fairly expensive multiple, not bubble-like, not something you couldn't rationalize at all compared with the growth rate, gone down now to around 1.3, which makes it look very cheap. This doesn't mean it's a definite buying opportunity. There are things that we need to look into, and obviously there are some uncertainties. The stock doesn't just drop like this for no reason, but it's a good sign that there could be an opportunity here with THG. Now, I want to look at the financials, because just keep in mind that multiple that we're seeing at the moment. So remember, 1.5 times sales, 1.5 times forward sales. Now, if we compare that with the growth rate that we've seen over the past 3 to 4 years as the data that we've got here, they've gone from 500 million in revenues to 1.6 billion in revenues. Last trailing 12 months is around 1.9 billion in revenues. That CAGR is in excess of 35%. The latest growth rate year over year was 41%. Now, you compare that with a 1.5 times sales multiple, and the stock does look very cheap. Also look at gross margins, because gross profit growth is going to be more important than revenue growth. Obviously, we could grow revenues to the moon if you're doing it at no cost, but we see the growth rate on the gross profit side of things, so actually money traveling down to the bottom line, is around about the same as the top line growth. This year, it was actually better than the top line growth. It's losing money, but analysts, which we'll see quickly now here in the estimates, are expecting them to be EBITDA positive in the next year and in 2022, with an expected EBITDA margin in the region of, say, 9 to 9.5%. We look at that just as a proxy quickly for valuation. That expected EBITDA, say in 2022, 270 million. That is around 12 times EBITDA, 12 times forward EBITDA for next year, where the current price is. So if you're someone who doesn't like to look at EV to sales or price to revenue, which is fair enough, just if you can't sort of rationalize why investors would look at that. If we just look at this as a proxy, then the expected EBITDA in 2022, so next year, 12.5 times that you'd be paying for at the moment for a company that's expected to grow those revenues at 32% CAGR for the next sort of 2 years. Doesn't look like a bad deal on the face of it. So that was just a quick review of the numbers, just to see, if it's even worth pursuing at this point, if it's something that looks like it could be good value, if everything else falls in line. So I actually need to give you some details on what THG is now, what the business is. That is, of course, the most important thing. So we'll just use this here. THG essentially, if I can summarize, are a digital first retailer. They operate in the beauty sector. They own various brands. They're one of the leaders actually on the digital side of the beauty industry. That's worldwide as well. So we'll get into the numbers in a moment. They've also got a nutrition business as well. They're one of the leading nutrition brands, or own some of the leading nutrition brands globally today. They've got an on-demand part of the business, which is essentially a media services business. And then we've got Ingenuity, which is sort of what's the most appealing part of the business for investors. And definitely when they originally IPO'd, this was what was being built up to be the exciting part about the company. And what Ingenuity is it's an end-to-end e-commerce offering, not just for THG's own brands. It doesn't just power their own e-commerce offerings, but they also license it out to other brands who are trying to develop an e-commerce offering as well. They do that globally with some very big brands. They've got Homebase here in the UK that they have a big partnership with. They signed a partnership with Nestle. They have one with Coca-Cola. Not exactly to take over their full e-commerce offering, but it's more or less just powering part of their e-commerce offering. There is a bit more that we need to get into on Ingenuity that is part of why their stock has dropped so much, but I just wanted to give you a quick overview. The sales mix is actually quite geographically diverse. So we've got the UK making up 39%, Europe making up 24%, rest of the world 24% as well, and then 13% in the US. So this isn't just a UK company, this is a global company in terms of their brands and the revenue streams that they get. And just to glance at the latest results, this is the first half of 2021 that they released, I think, around 3 weeks ago, and you can see that growth is carrying on for almost all areas of the business as it was before. 55% in the beauty section of the business, which is the largest, 27% in nutrition, which is the second largest but oldest part of the business. Ingenuity, excluding e-commerce, 40%, on-demand 45%, and then Ingenuity Commerce up at 165%. So already beat what it did last year and the whole year in the first half of this year. So growth is still there. Growth isn't the reason for this price drop. I just want to sort of make that clear. Adjusted EBITDA, so they are making money on an adjusted basis. We do want to look at what actually they make adjustments on to figure out if that's credible or not. But on an adjusted basis, they've made money in the first half of this year. Now, getting into part of the reason for the drop. This is the first reason for the drop we'll just look at in the investor presentation. Then I want to look at an article which actually summarizes a lot of the investor sentiment, at least here in the UK. So this strategic update that they gave in their first half 2021 results was something that I think got investors a little bit anxious about what this could mean for the company. So they said THG Beauty, which is the largest part of the business that we saw, making up around 700 million of the 1.6 billion last year, will be listed as a public company in 2022. So it's going to be spun off. THG will still retain ownership, and THG shareholders will still retain ownership of THG Beauty. It seems to be the reason for it is that they'll be able to raise more capital through the public markets if they list it as a separate company, or they may be able to unlock more value out of the business by separating it. It's not something that I would be happy with, if I was an investor in THG at the moment, but it's something that if you're not an investor already, or even if you are an investor, you need to look at it objectively. So not ideal, but it's something that you'd need to dig into a bit more to actually see what it would mean for your share in THG. I would imagine that you would just be given THG Beauty shares in exchange for your THG share, and they'd be able to sort of pro-rata it in a fair way. But there's not many more details that have come out about that at the moment, exactly how that deal would be structured. So I guess that's something that is giving investors cold feet. Now, digging in a little bit more as to why the company has dropped 60%. Remember, the purpose here is we're trying to look for a reason as to why the stock would drop 60% in the past year or 50% in the past month, and a viable reason as to why it's selling at seemingly such a cheap price relative to the prospects of the company. So we've got this Sky News article here that we're going to dig into. It's why the Hut Group looks set to remain in the doghouse with some investors. And this really provides us with some insight, at least in the UK, which is the majority of THG investors, as to why investors are not happy with THG and have been selling their shares. And we've got something here that says some investors dislike the incentive scheme for Matt Moulding, who's the CEO and chairman and co-founder, where he stands to make as much as 700 million. But do remember, this is a CEO or chairman who owns in excess of around 15% of this business. So he's a founder CEO. He has as much incentive to make this work as anyone else. So we'll go back to that in a moment. I haven't really looked into the incentive scheme in much detail, but I can imagine that it's split off over a number of years and tied to certain performance metrics. So we will look into that at some point. But some of the reasons that this article was given as to why UK investors are unhappy about holding or wanting to sell their THG shares. And one of them here is just ridiculous, really, that Matt Moulding was the founder, chairman, and CEO of the company, an arrangement usually frowned upon in UK listed companies. And that's just ridiculous. If anything, you want your founder to be the chairman and CEO. And the reason they give here is because the founder could potentially block takeover bids for the next 3 years. I don't see what the issue is with that. I really don't. And it tells you a lot about the ways in which mutual funds in the UK list their companies. I can think of numerous examples where some of the best performing stocks in the world or in the past 10, 15, 20 years have been through founder-led chairman and CEOs. So that's not really an issue for me. Now, one of the announcements that probably did shake investors somewhat was that Softbank would be investing into THG. They were investing $730 million or £537 as part of a $1 billion or £730 million fundraising that THG was doing to help grow the business. But what was accompanied in this announcement was the fact that Softbank would be given an option to buy 19.9% of THG Ingenuity. Remember that fast-growing tech e-commerce platform that they have that powers other businesses around the world. And that would be an option that Softbank would be given with this investment. And it's highly likely that that option will be taken up in some point in 2022. And I guess that it's something that you don't really want to see again. If you are owning part of THG already, the fact that a company has just swooped in and taken 20% of what you probably thought was the most exciting and prosperous part of the business going forward. But when you look at how they valued THG, so this SoftBank arrangement in which they're investing $730 million to get 19.9% of THG Ingenuity, that valued just that division of the business at £4.5 billion. Now, compare that with the market cap today of £3.4 billion. And we've got a situation where SoftBank, a famous investor, not always right, they have been wrong on many occasions, but they would have seen a lot more to do with THG Ingenuity or know a lot more about Ingenuity than any other public investor if they were investing that sum of money just to get a small share of it. So they probably have a better idea about the prospects of that platform than we do. And they valued just that division at $4.5 billion in that fundraising. So you can buy the entire company now for about $1 billion less than that, which I think is quite remarkable, especially when someone like SoftBank has had their hands over it. And so there's another reason. We're starting to see a pattern here. We've obviously got a number of catalysts that are compounding on themselves. The TH Beauty spin-off announcement, the SoftBank investment into Ingenuity where they're taking a share, the incentive scheme that the founder and CEO has. And then we've also got this quite pathetic statement here. And I've seen this as a common theme actually in some other articles that I looked into. Some are arguing that THG is valued more like a tech company than an online retailer, than an e-commerce platform, essentially, which provides you with no context whatsoever. Like, what does that even mean? Is an e-commerce company not a tech company? I think when Amazon were growing as quick as they were, people were not calling it a retailer, people were calling it a tech company. People do still call Amazon to this day, regardless of AWS, a tech company. But being objective, I guess they could have a point if they're talking about the future margin potential of the business. But every company needs to be individual in its economic profiling. And you can't just say because it's a tech company, it needs to be valued as such. If a tech company is growing at 5%, you don't want to value it like a tech company and put a 10 times sales multiple on it. And then on the flip side of it, if you have a company that's growing in excess of 40%, like we have here with THG, what's to say you should value it like a traditional retail company? In my opinion, especially at this point where we have no solid earnings with THG, they're not making money on a consistent basis, only on an adjusted basis. THG should be valued using the growth rate as a proxy. And I think, for me, I value most companies using the growth rate and margin potential as a proxy. But here we have to keep the potential mature state margins in mind, which going off the adjusted numbers is a little under 10%. Probably could be stretched above 10% once they get to maturity. So even if you just go with around 9 to 10% as their mature state margin, you need to be using the growth rate as a proxy. If Walmart, just as an example, was growing at 40% year over year in the 80s and 90s, you would have been silly to apply a 10 times PE to it just because it was in retail. It seems like a silly answer or reason to even be selling or arguing that that's the reason why the company has sold off. But that is just the way in which a lot of analysts and mutual funds look at investing in the UK. It's quite remarkable to think that these people were paid so much to do such a bad job. But I think a lot of this just comes down to investors, or should I say traders, not knowing what they own or even putting in the effort to know what they own. So we need to do some investigating just to see if that really does impact the business as much as we've seen the stock drop. And so, as you'd expect, I have done a little valuation model or underwriting sheet for THG. I'd say it isn't too specific and it isn't going to be that accurate. It's just a method of putting the numbers into perspective to see if the valuation makes a lot of sense at this point. And remember that if TH Beauty does get spun off in 2022 as a separate entity, there will probably be, as part of the fundraising, or there would be no point spinning it off, there will be some share of that business that will be obviously diluted out of THG's 100% ownership and folded into the public market. So that may be something as little as like 10 to 20%. Again, with the Ingenuity business as well, Softbank likely to take 20% share of that business looking forward. That's growing at around 160%. So that is fast growing. It's not easy to put any sort of number or forecast on that at the moment. So all we can do is add a hint of conservatism into the forecast to try and account for both of those things. But this does represent the revenue and profit share that THG will have, even if it does spin off any of its businesses and it becomes more like a holding company. As you can see here, I've just gone with a 25% CAGR in the revenue, which is down a lot from what we've seen in the past 5 years. But actually, I think 25% CAGR for the next 4 to 5 years is probably more accurate than seeing the 40% growth or 35% growth continue. So we'll go with that. Gross margins, they have actually been pretty steady the past 3 to 4 years. So around that 45% range, we'll keep it at that. That should mean in 2025, this is a business that could pass down 2.2 billion in profits to the bottom line. And you'd hope at that stage, where they've got a 10% adjusted EBITDA margin right now, which is including things like stock-based compensation and other what they would call one-off costs. We need to be careful with that, but it does give us an indication, like I've said previously, as to the economics of the business. Now, if we believe in 4 to 5 years with that kind of scale, almost £5 billion in revenue, they could reach their 10% EBITDA margin, maybe even more than that, but we'll just keep it fairly simple with 10% at the moment. We account for some dilution as well, because I do expect some dilution in the shares outstanding. So I've accounted for that 3% and then apply a 15 times EV to EBITDA multiple in 2025, so on judgment day. And we get an enterprise value of around 7.3, 7.4 billion as a hypothetical value for the company in 4 years' time. Now, remember, this is more or less what we're taking value from at the moment. We're not using a stream of free cash flow over the next 4 to 5 years because we don't know exactly when this company is going to be profitable or able to put money back in investors' pockets. So we're just basically looking at what is the company going to be worth in 4 years, and then can we discount that value back today? So if we use that method of valuation, we're getting an intrinsic value for the business of around 3.8 billion as a market cap, or a share price of £2.92, which is not actually much above where the share price is today. Remember, I am using my required rate of return of 15%, so a relatively high discount rate. Other investors may be looking at this with, say, a 10% discount rate, a more normal discount rate, which shows the company as very much undervalued based off of all of those forecasts up there. But if I keep 15%, which I think actually does reflect some of the risk here, of course, it's an early stage high growth company, not yet profitable, and also spinning off some of its assets. Doesn't necessarily mean that we're going to lose money because of that, but spinning off some of its assets. So I think the 15% discount rate is fair. And then, off of this DCF or off of this valuation model, it doesn't show THG as a no-brainer, I've got to say. Although it seems very cheap, it's dropped a lot in the past few weeks. It doesn't show THG as a no-brainer, but does show it as somewhat undervalued. So that's a quick summary, guys, and just wanted to get on here and explain the THG situation. It is a business I'm going to be looking into more. If I can find, out a lot more about the brands itself and the underlying businesses that THG has, I may get more confidence that they could grow at quicker than 25% CAGR, and may get some confidence that they could reach over a 10% margin, especially if the tech business is going to be the core area of the business in 4 to 5 years' time. It seems as though that's what THG are pushing. They're saying that the e-commerce platform, or the Ingenuity platform, the infrastructure platform, is going to be the largest part of the business at some point. And with that being a SaaS model, that could be a 30 to 40% margin business. So I'm going to do a little bit more work on it, and then I will come back to you guys with what I find. But hopefully this is a good summary of the opportunity that is there at the moment, and you can go and do some work on it yourself. So thank you all for watching. I will see you in the next video. Good luck with your investments.